Earlier this morning, we reported our March quarter results, posting pre-tax earnings of $380 million, or 45 cents per share. Free cash flow was $1.4 billion, and we delivered a return on invested capital of nearly 14%, putting Delta's returns in the top half of the S&P 500. Our teams have delivered operational performance that is among the best in our history, with mainline cancellations down 85%, setting new records for completion factor in both the fourth quarter and the first quarter. In February, we recognized the efforts of our people with $1.4 billion in profit sharing, more than the rest of the industry combined, and continuing Delta's longstanding philosophy to reward industry-leading performance with industry-leading compensation. Recognizing our investment to ensure the future of travel is connected, we took the #2 spot in the travel category, a Fast Company's list of the most innovative companies, the only airline to be recognized in the ranking. Loyalty to our brand has never been stronger. We continue to set new records with our remuneration from American Express, our most important commercial relationship, and are well on our way to our long-term target of $10 billion. On February the 1st, we announced enhanced and refreshed benefits for our Delta SkyMiles American Express cards, providing more direct value, and the customer response has been very positive. With strong first quarter performance and visibility into the strength of summer travel demand, we remain confident in our full-year guidance. For the June quarter, we expect to deliver the highest quarterly revenue in our history, a mid-teens operating margin, and earnings of $2.20 to $2.50 per share. Demand continues to be strong, and we see a record spring and summer travel season with our 11 highest sales days in our history, all occurring this calendar year. Spending on services recently surpassed goods for the first time in 5 years, and there is further runway to return to their long-term trends. When you put this level of demand strength together with the industry's increased focus on improving financial returns, this may be the most constructive backdrop that I've seen in my airline career.
Revenue for the March quarter increased 6% year over year to a record $12.6 billion on capacity growth of 6.8%. This result is at the high end of our initial guidance, with upside driven by industry-leading operational performance and strength in close-in bookings. Since the start of the year, we've seen a sustained acceleration in business travel. Managed corporate travel sales grew 14% over the prior year, with technology, consumer services, and financial services leading that momentum. Premium revenue was up 10% over prior year, and we have runway ahead as we continue adding more premium seats to our aircraft, improving our retailing capabilities, and further segmenting our products. Following the refreshed co-brand benefits, we saw our card applications reach new records as we are seeing the highest premium acquisition in our program's history.
Fuel prices averaged $2.76 per gallon, 16 cents higher than the midpoint of our guidance range. Operating margin of 5.1% was a half point higher year over year. Debt reduction remains a top priority. We repaid $700 million of debt, including $400 million of scheduled maturities and $300 million of additional debt initiatives. We expect to repay at least $4 billion of debt this year and continue to be opportunistic in accelerating debt reduction.
Hey, thanks. Good morning. What's your visibility to second half RASM inflection? I guess ultimately, at this point, do you see more upside or downside risk to that flat RASM?
What I would say is that we're ahead of our internal plan to get to flattish for the year. I think we see a great setup for the back half of this year, and we're on plan or ahead of plan for where we sit right now.
Okay, and then I just want to follow up just on RASM a little bit. So if you look this year, you're guiding again to really outperform pre-pandemic seasonality. I'm wondering, do you think that there's a seasonal shift from Q3 into Q2 relative to what we used to see? And is that helping Q2? Does it potentially hurt Q3? I'm just curious your thoughts on that.
It has changed, and it's related to schools coming back in the South in particular earlier and earlier into August. As a matter of fact, here I believe schools in Georgia go back the first week of August now. And so that has materially changed, I think, over the years, making the second quarter stronger and making the third quarter a bit weaker.
Thanks very much, operator. I just have two questions. In the first quarter, your landing fee seemed a little bit higher than I would normally expect to see for our first quarter. Maybe you can explain that.
Yeah, on landing fees, when you look at it year over year, yes, they're up. Volume 1, 2 related to the cut-in as it relates to our generational redevelopment projects. You're picking up some of that expense. And then I would say the third item, airports across the country in 2022 and 2023 benefited from CARES. And as those have now gone away, they're adjusting their rates, and you're seeing that come through.